Before we kick off with the 10 stocks that you want us to have a look at, I thought I'd throw in PointsBet today, updating the market this morning, saying it successfully completed its institutional entitlement offer, raising $81 million, the gaming business. The move strongly supported by both its Australian and international institutional shareholders, with around 78% of eligible entitlements snapped up by existing shareholders. Final clearing price under the book build came in at $10, 25% premium on the entitlement price offer of $8. Under the offer, 10 million new shares issued. The retail component of the entitlement offer will start this Friday and is set to close 2 weeks later. So, of course, for our audience, the question is, should shareholders take up the retail offer? Scott, what do you think?
That's a really good question, because that's different from should you buy the shares outright. Yes. Look, I think if you own the shares, you obviously like the company, you like what we're doing, or what they're doing, I should say, and at a big, big discount to what the previous price was. If you weren't selling your shares at a much higher price, doesn't mean you should necessarily buy at a lower price, but you'd be pretty close to saying, well, hang on, if I wasn't going to buy or sell, at 11 or 12 bucks, why would I not buy at 8, 9, 10? And so, look, I think in this case, if you do like the story still, if you like PointsBet, if you still like the idea, and you feel like you want more in your portfolio, no brokerage, discount to the current price. Frankly, you're already wearing the share price fall of today. So I wouldn't be adverse to anyone taking up more shares, as long as you manage your portfolio, as long as you understand your risk profile, and assuming you're still happy with the company's value after the book build. I think it's probably a good idea to take up those rights.
Mark?
A difficult one. It's only been listed for 2 years. I had a look at it. This is a bookie company that does sports betting and all sorts of betting through hotels and clubs and so on, a lot in the US. So it's been around, obviously, as a private company prior to that. But since it's been listed, and as I said, it's only got 2 years, it's been pretty sorry from an earnings point of view. So they lost 23% of their capital last year. So return on equity was negative 23%, which is probably why they're doing a rights issue. So profits continuing to go down. So if you look at it from 2020, it was negative 25 cents. Now it's negative 51 cents. However, sales have been growing strongly since they launched, and they're actually growing at 118% a year. So the theory would be, and I'm sure this would be the reason that people who have shares in it would consider taking up the rights issue, is that they will get to profit based on their sales growth. So if sales keeps growing strongly, there's probably no reason why they shouldn't get to profit. I don't know anything about the management. I think their record so far doesn't look at all inspiring to me. But if you believe that the commentary from the company and where they're going, I agree with Scott. You probably would take it if you still believe it. But that's what you'd have to do. There's no way I would buy this. It's not a company that Teaminvest would consider. In fact, the whole betting area is not an area where our members tend to show much interest.